So even Vilas sir has joined. Good morning, everyone. Myself teachers on behalf of Kirin Advisors. Welcome you all for the webinar of Shri Keshav Cements and Infra Limited. On the management side, we are pleased to have Mr. Venkatesh Katwa, Chairman, Mr. Vilas Katwa, Managing Director of the company. To begin with, I would like to give a short introduction of the company, after which I'll hand over the call to Mr. Venkatesh to give a detailed overview of the company. Incorporated in 1993, Shri Keshav Cements and Infra Limited is engaged in cement manufacturing and solar power generation and distribution in the state of Karnataka, India. With that, now I hand over the call.
Yeah, good morning, everyone, and welcome to Shri Keshav Cement and Infra Limited Q1 FY26 earnings call today. I sincerely appreciate your time and interest in joining us today. Shri Keshav Cement and Infra Limited, what we usually call SKCL, is engaged in the manufacture of cement and power generation from solar industry, primarily in the state of North Karnataka. Our cement plant is situated in Bagalkot and solar plants in Koppal, both in the North Karnataka region of the state. And our distribution network for cement spans in North Karnataka, Coastal Karnataka, Goa, and parts of Maharashtra, supported by over 350 cement distributors and 600 retail touchpoints, and over 14 solar power consumers. So let me take you through our performance in Q1 FY26. We are very pleased to start the year on a positive note. For Q1 FY26, total income grew by 32.53% year-on-year to 41.4 crores, supported by robust cement demand, steady solar power contributions, and improved capacity utilization from a new kiln commissioned in March 2025. EBITDA rose to 10.41 crores, delivering a margin of 25.5%, while profit after tax surged by nearly 74% to 3.09 crores. This strong performance reflects the benefits of our capacity expansion, a better product mix, and disciplined cost control. The cement segment saw healthy traction from infrastructure and real estate projects in our core markets, while our solar operations continue to provide a stable, low-cost energy backbone for our plants. With increase in our cement capacity almost completed and power entirely by renewable energy, we are well positioned to capture opportunities in the growing urban centers. Rising public infrastructure spending and continued momentum in housing and commercial construction provide a favorable demand backdrop for the rest of FY26. Our strategic focus remains on optimizing capacity, deepening green energy integration, enhancing our product mix, and expanding into high-growth urban areas such as Bangalore and trying to reach out to Kerala. Before moving into a QA session, I extend my sincere thanks to our shareholders, partners, consumers, and employees for their unwavering trust and support, which continue to be the cornerstone of our growth. With this, I am pleased to open the floor for questions regarding our earnings call, and thank you once again for being part of us today. Thank you.
Venkatesh sir. So with that now, we open the floor for Q&A. Investors, you can raise your hand and I'll allow you to unmute, or you can also drop your questions in the chat box. So yes, Priyank, please go ahead with your questions.
Yes, am I audible?
Yes, Priyank, you are audible now.
Good morning and congratulations on commissioning of the new capacity, and it's good to know to the rationale for expanding the capacity. As you the South market has been little volatile most of this capacity expansion.
Priyank, I lost some part of your question. So I heard till the point where it says, has it been? Can you just repeat the question real quick again?
So I just want to know the rationale for increasing the cement capacity since the bigger players have also greenfield and brownfield plans to increase the capacities. Do you think this capacity expansion can really have sustained realizations?
Absolutely.
Mm.
So let me come back. The whole rationale for going for this CapEx was basically to, increase our EBITDA margins or EBITDA per ton, which is what was lacking because of very high fuel and power consumption. So as expected, since the kiln has just started and, as we kind of stabilize, the EBITDA per ton you know, has grown now from around hardly 100 or less than 100 rupees last year to over 365 rupees this year, this quarter. And of course, with the increased capacity, we qualify for a lot of other government-related projects, and we are beginning to get some traction and also some sales have been generated for infrastructure projects by the government of state government, and it will continue to increase as we move on. And I also heard regarding, overcapacity in the south. Yes, south is adding significant capacity, as well as the realization in the south is not very significant compared to the rest of India. And we are almost huggy-backing on the south performance. So, for example, the Cuban cement prices year on year for South reduced by 3%, whereas for SKCL it reduced by about 1.2%, almost the same. The EBITDA per ton for South-based industries was around 560 rupees. This data and for our SKCL is about 360. This data I have received from various sources where only dominant South players we have taken, and based on that, these are some of the results we have observed. So pretty much.
Can we expect our company to also reach this figure of 560 or nearabouts?
Yes, as we move along, as we stabilize our plant, of course, it has just been one quarter, and we have not got fully the desired results what we were expecting. But then again, as we continue to operationalize the plant, as we continue to enhance our efficiency, eventually by the, another couple of quarters, we should be able to be close to what we see in the southern region.
And this average realization and stabilization of EBITDA, do you think it will be complete within 1 year?
I believe so, because this year the whole the plan has been to stabilize the plant in such a manner that we reach all the efficiency parameters as was designed to set up this plant itself.
My next question is regarding the solar business. Can you throw some light on whether you are able to sell some power to third parties, merchant power, and what are the rates which the company is able to command on what capacities?
So approximately now solar generation compared to year on year almost remains same. In spite of adding 3 megawatt to make it a totally 40 megawatt, because we experienced early rains this quarter compared to a general rainy season. The realization part compared to Q4, marginal increase in pricing we received from 5.82 in Q4 FY25, we have reached to 5.98 in Q1 FY26. So the solar pricing will remain stabilized between 5.9 to 6 throughout the year. And unless there is a change in discount prices, these prices are going to remain stabilized. And solar power generation, as usual, is giving the lot of EBITDA contribution to the results as of now. Thank you.
The final question I have is regarding the debt servicing and debt repayments. Is any substantial repayments coming up in next 1.5 years?
This financial year, we'll see 3 term loans being closed, out of which one has already been closed out of, out of the when there is a maturity. One term loan was closed ahead of time. In fact, another term loan was supposed to be closed in January. Due to cash inflow, we closed it ahead of time. And another term loan will get closed by March. So this year, 3 term loans are getting closed, whose initial value is around 42 plus about almost 62 crores worth, which was sanctioned, will get closed this year. And only this year we will have a repayment liability highest. From next year onwards, the repayment liabilities will start going down because the term loans are getting closed one by one.
So you are confident that you will be able to close this loans through internal accruals, or you'll have to raise some more capital because this is being first year of operations for the cement plant?
I believe so, yes. This year also, with the increase, if you look at the Q1 results and EBITDA margins and cash profits, we are at cusp of the point where our realization will start going up, sales will start going up, profit will start going up, and the borrowings will start going down. So I'm pretty confident that for this year we should be able to repay the loan through internal accruals. And if there is any shortage, the management is always pouring funds when there is a need.
So that means, in effect, you are saying that the company's EBITDA will surely more than be doubled from the last year?
This year, definitely yes, because our first quarter EBITDA itself is around 10.5 to 11 crores. So, and typically, this first quarter, we had early monsoon. So second quarter is also going steady, and the most we will expect to accrue is in Q3 and Q4, where we should be expecting EBITDA levels where we should be able to service debt and repayment smoothly.
My best wishes to your whole team. You have done an incredible job of trying to fund this expansion more through internal accruals and little bit from shareholders' help. My best wishes to all of you. Thank you so much.
Thank you, Priyank.
Thank you. Thank you, Priyank. Saban, please go ahead.
Am I audible?
Now you're audible, yes.
So my question is around the cement rates. Let's say with the last year or last quarter, how much cement rates has increased now?
So compared to year on year, the cement prices.
Let's say year for the cement rates.
So across the year, you're saying? So Saman, I mean,
Hello.
across. Hello, can you hear me? Hello, am I audible?
Yes, sir, you were audible. I
Yes,
think
yes.
there's some network issue.
So typically, Mr. Saman, the realization has slightly increased in Q1 of FY26 compared to last year. Last year, only except Q1, Q2, Q3, Q4 were pretty bad, but the increase has been around, all over, I mean, quarter on quarter, the price have increased by 7%, but year on year, the price have reduced by around 1.2%, pretty much what we have seen in South India. So as of now, being the monsoon for Q2, price have not been so encouraging, but typically what we expect in Q1, we have seen some increase in prices. So to give an example, our naked cement price were around 3,433 for Q1 FY26 compared to 3,477 for Q1 FY25. In spite of that, our EBITDA level were higher because of the new kiln and the new efficiency that has flown in.
Okay, and how much is the current utilization of new plant?
So since the new plant,
this year and next year in terms of utilization.
Sure. So as of for first quarter, 36% is what is utilized because this being the first quarter itself. So we are targeting around 45% this year, and then slowly rake it up to about 55 to 60% next year, and around 70% the following year.
And when this new plant has been operated, which month or which, let's say, which week in this quarter?
So only the kiln is operational as of now, which was by end of March 2025. The rest of the supporting equipment are adding one by one as we speak. So technically, we have a kiln which can help us produce 1 million ton of cement. Some in balancing equipment, it will be added online maybe this month and few next month itself.
Okay, thank you.
Thanks a lot, Mr. Saman.
Thank you, Saman. Mr. Kush, please go ahead.
Hello.
Yes, good morning, Mr. Kush.
Hi, good morning, sir. Thanks for the opportunity and congratulations for the good set of numbers. So, actually, sir, I wanted to understand that the new plant is in South India, right?
Correct.
So, is it going to impact our growth as the price realization is better and even the demand of cement is better in North and Middle India? So do we have any capex plans going forward?
As of now, for cement, we want to stabilize the recent capex that we completed. So once we stabilize this plant, then we would think of in adding another level of capacity. But right now, South is over capacity. But in spite of that, we are able to, for example, our year-on-year volume growth is around 42% compared to average South year-on-year volume growth is only 9%. So we are pushing and we are capturing more market than what our South other peers are doing. So as of now, there's no plan of capacity addition till we stabilize this existing plant.
So from it, I can understand that for the next 2 years, like until FY27, we don't have any capex plans, right?
Not in cement, yes.
Yeah. So again, if we look at the South market as well, so the EBITDA growth in EBITDA is mostly due to volume growth and not because of the value growth, right?
Yeah, pretty much I would think so.
Okay, sir. And what's the growth in our other segments of business other than cement?
Our other segment is solar.
Yeah.
So solar, last financial year, we added another 3 megawatt. So the total plant is of around 40 megawatt. Around 200 crores has been capital expenditures on, establishing this plant since 2018. And right now,
How much we have invested? Sorry.
Almost around 200 crores. I think about 195, 196 crores is what we invested in solar projects to, set up around 40 megawatt of a plant.
Okay. And how much do we earn per megawatt?
So the realization for this quarter has been about 5.98. The last year, entire realization was around 5.95 the entire year. So that is the net realization what we are getting because the solar plants are incentivized by the government for 10 years. Another 3 years is to go. After that, there are certain, statutory charges will be applicable, but they're not going to be significant once, we have our plant stabilized.
Okay, so actually I missed your number. So 5.98 crore is for Q1 or the whole FY25?
So average price is 5.98 rupees per unit. But
Okay.
out of total EBITDA of around 11 crores, around 7.8 crores is contributed by solar and only 3.2 is contributed by cement. Solar has always been a highest EBITDA contributor currently.
Okay, sir. So what would be the payback period for us from our solar project?
So solar project typically about 8 to 9 years, what is applicable to all other solar plants in the country.
Okay, sir. And do we see any major OpEx in solar? Because in maybe 5 years down the line, we might need to change some solar panels.
So there are a couple of things on solar. One is once the cement plant stabilizes, management would like to consider addition of more solar capacity. Plus, somehow current evacuation capacity of the solar plants will support a very high, almost 3 times higher generation. For example, if we have 40 megawatt right now, the evacuation capacity is of nearly 200 megawatt. So in future, what a lot of other and old plants are doing is they're simply changing the panels from the old capacity, new capacity, and adding few transformers by which they can drastically increase the capacity. And we would be looking at that kind of a transformation, not right now, maybe about 5 to 6 down the line. So
Okay.
currently, for example, we are using 320 watt peak modules for the existing plant. There will be a point in time where we could expect to reach around 1 kilowatt peak modules. At that time, it will make sense to replace the panels and make some internal infrastructure adjustments to immediately, instantly achieve higher generation.
So, matlab, our payback period would be around 10 years in this.
For the existing plant, about 8 to 9 years, but in future, when we, assuming that the solar panel price do not change, the payback period is going to be lesser because then our existing land, our existing, what we call as model mounting structures and a lot of other infrastructure will remain constant. The only change will be in the panels and transformers. So the investment is not going to be significant. And thus, we would expect lower payback period.
Okay. And do we expect the price per unit to remain same throughout the year?
This year, yes, because typically the regulatory charges are, are done for a year long. So for this year, whatever regulatory charges have been applied in the state of Karnataka will remain same. So I would expect, currently in Q1 I have received 5.98. So typically between 5.9 to 6 is the range what you would reasonably expect for this year, the price, average price for solar sale.
Okay. And in the whole year, how much we are expecting from solar in FY26?
So solar will continue to go down now as we keep ramping up on the capacity. The solar, sale units are going to go down. So once we reach around, 60 to 70%, I think almost all the solar capacity will be utilized.
Okay. So, matlab, what would be the numbers?
What number? I mean,
For solar, from solar. The top line from the solar or the bottom line from the solar for the whole year, FY26.
So when I generally give out the solar EBITDA figures, these are all notional EBITDA figures because internal consumption is considered at the price what we are selling outside.
Sure.
But as we move on, the EBITDA figures will get embedded within the cement sales itself. Only for the sake of notional EBITDA separation, because when we compare cement plant to other cement plants, we will have to compare on cement EBITDA per metric ton, considering apple to apple comparison. But as we move along, once we start consuming entire solar power, there won't be any solar sales. However, cement EBITDA would show, a significantly higher per ton basis.
Okay, sir. Got it. I will join the queue again.
Sure. Thank you.
Thank you.
Mr. Kush, yeah.
Thank you, Kush. Mr. Bharat, please go ahead with your question.
Hi, sir. Thanks for the opportunity and congratulations for a good set of results. A couple of questions, sir. First, can you just talk a bit with respect to the institutions orders? I think you were mentioning in your opening remarks about the government tenders. So can you just share some highlight about the progress on the same?
Yes. So last quarter, on the mid or, I think in the last month, we began to start striking, having orders from what we call as Cridle, who does a lot of development work in Karnataka. Cridle itself is it's an infrastructure development corporation of Karnataka who builds roads, bridges, and the stuff like that. So, we were able to dispatch around 3 to 4,000 tons last quarter, since it was just the beginning. So this quarter, we're expecting to more than double that quantity. And once we establish here, we'll keep adding more such institutions. Only because, right now we have increased capacity and all other parameters we qualify for the for such kind of orders. It will start showing up, fully, another couple of quarters down the line. But already we have put our foot in the door and we are beginning to get full-fledged orders from them.
And sir, how the realizations will be, like with respect to the B2C sales versus the government orders? The next cement price remains the same for us?
No, they are little better. because one advantage of institutional buyers is they price the same for certain grade of cement across all the cement plants. So there is no differentiation on the basis of branding. So that works out to be a little advantage for us. So compared to a lot
And
of tier one brands, you know, tier one brands tend to give them a discount, and those even discounted levels tend to be higher than our realization. So yes, it is going to be at least 10% higher than our existing net realizations.
right. And sir, like you mentioned that you are targeting 45% kind of a utilization even on the enhanced capacity. I think we were mentioning somewhere close to doing out 50% and above. So has there been any downward revision in the guidance? Like earlier we were guiding for 70 crore EBITDA. So is there any negative revision on the guidance for this fiscal year?
So typically what happened was we expected the kiln to perform efficiently right from day one, which, you know, of course, we had little ramping up issues with the kiln. And some of the balancing equipment which will add to the kiln capacity have been a little slow in implementation. So they're almost in the final stages right now, because of which we don't want to be over the board. So 45% as of now with the current cement scenario appears to be reasonable. But the way we are trying to market and sell is we are trying to push it as much as possible, even targeting around 60%. Just to be on the safer side, you know, the revision has been done to looking at the current scenario. Yes, with a little dip in capacity utilization, there is going to be a little dip in the EBITDA expectations too. So reasonably, we are expecting EBITDA of around 55 to 60 crores this year, compared to what we had predicted around 70-75 earlier.
And on the PAT front, sir, it would be somewhere close to 30 odd crores, like you mentioned on the last one call.
So PAT, this is something which is important to discuss. What happens in PAT is we have something called as deferred tax liability, which is showing it before the PAT figures. So as a management, as the industrialist, we can typically target on EBITDA and PBT. So PAT is a derivative of some of the deferred tax liability, which are most of an in-days adjustments. So based on what I understand on how deferred tax liability is applicable, so about 25 to 30 crores is what I should expect. Typically, we are expecting very high PATs in Q3 and Q4, which we technically see in cement industry.
Right. Sir, also we were doing some pilot phase with respect to RMC. So any progress there we have made in this particular aspect?
So RMC, as of now, we are still studying on the project. I mean, in fact, the study has been completed. We have already the land required for the project, but the project will be initiated once we see some stabilization in the cement plant, which we were expecting earlier, but now with the, with the teething issues that we had in the first quarter, so it might be delayed by another quarter or so.
And sir, when do we see the stability built in, like with the balancing act coming in place? So can we see the stabilization of the plant by Q2?
Q2 or max by Q3. I would say Q2 will be the point where all the stabilization process will be taking place. So you will see some better results in Q3. That is what is the realistic expectation that we have right now.
Right. And sir, any colors on the capex for this year? Like any plant of addition in the solar side?
No plans in the solar side. There could be a possibility of solar and RMC, but decision has not been taken since we want to stabilize the cement plant first. So if I see complete stabilization by end of Q2, which is really expected, then Q3 we would be thinking of a capex in solar as well as in RMC.
Right. And so, like you mentioned, there has been an improvement in the realization on a quarter-on-quarter basis. So, do you think the trend will continue over the rest of the year? Like, particularly with respect to Q3 and Q4, do you see there will be uptick in the pricing realization?
So EBITDA per metric ton has definitely been uptick. It is this quarter we achieved the highest EBITDA per metric ton since inception. For example, in FY25, the EBITDA per ton was less than 100 rupees. Year before that, it was hardly 75 rupees EBITDA per metric ton. This quarter, we reached about 365 rupees. And this is just the beginning. So once as the capacity starts adding up, And once we start increasing the capacity utilization, the EBITDA per ton also is expected to grow and start hugging with the south-based plants.
I was asking with respect to naked cement prices, sir.
The naked cement prices?
Right.
So naked cement price year on year it has reduced by around 1.2%, but quarter on quarter around 7%, which is almost similar to what we have seen in south. So even though Q1 has shown some increase in prices, the Q2 has been very slow, and because of early monsoons, very particularly because of early monsoons and heavy monsoons all over the region where we sell the cement. But we have noticed in the past that a good monsoon is always followed by a robust demand in cement and then the pricing itself. And if you look at some of the news articles from some top cement plant executives, they are predicting a significant increase in the prices of cement by the end of FY26.
Right, sir. And just a last question from my side, sir, like with respect to the enhanced capacity which we have, and with respect to increasing on the distributor connect, what sort of a progress we have been able to look? Like you mentioned that you are targeting newer territories or newer geographies. So any progress which you have been like for penetrating into those markets?
So yes, I mean, we are doing a lot of digital marketing. We are using a lot of new loyalty programs and all the other stuff. So simple fact that what we are doing, we started doing this from Q4 FY25, because of which, if you, for example, average South year volumes growth year on year was only 9%, whereas we reached 42% growth. Solely because, we are becoming very aggressive to make sure that entire capacity is sold. So this is helping us to build on our volumes. But yeah, apart from digital marketing and apart from loyalty programs, we are increasing the areas and we are beginning to see new customers added to the list. So the list goes on, and as expected, the ramp up is going on. In fact, the ramp up is going on as we speak in Q2 also.
So X of 300 kilometers radius, we are also looking at newer territories, whether it is market of Kerala or some other state.
Right now, we're not reaching out over there. What we're trying to do is dig in deep in the existing market. We're increasing our market share in the existing market itself, which is giving us positive results. We would eventually go to longer places once we know that these areas will kind of reach some kind of a stabilization point. Any cement plant would avoid to go as far as possible because of logistic cost. Typically, if a cement is selling out to a very long area, it means that they are reached a saturation point in their home areas. So in our case, we are increasing our volumes in our local area itself, which gives the highest realization, and we will continue to do so till we reach some saturation point, and only then we'll start reaching out to markets like Kerala, Pune, or Bangalore.
Right. And sir, for the overall capacity which we have of 1 million tons, what kind of a contribution do you expect? I'm not saying currently, but with respect to the next 2 years coming out from the government projects, like from the institutions, how much contribution to the volumes can come in from the institution side?
So, this quarter, Q1 was around 3 to 4%. Q2, we are expecting around 10 to 12%. So, with the kind of orders, what the kind of capacities, what they want, I think so eventually somewhere we should stabilize between 20 to 22% or 25%. So right now, this quarter, we would be expecting about 8 to 9, 10% contribution coming from institutional buyers.
Sure, sir. That's really useful, sir. Thank you and all the best for the subsequent quarters. Thank you so much.
Thanks a lot, Mr. Bharati. Yes.
Thank you, Mr. Bharat. Akhilesh, please go ahead.
Hi, are you able to hear me?
Yes, Akhilesh, please go ahead.
I wanted to know, we are already in a fuel station business as well as a small contribution, or we are planning to?
No, I could not hear the question properly. I don't know, it got disconnected. Come again?
Okay, are we already in a fuel station business, or we are planning to?
In what business did you say? Special? I couldn't hear that word.
Fuel station, I guess.
Yes.
Come again,
your
madam.
voice.
Yeah. Come again.
Fuel stations or petrol pumps? Are we having those businesses or we are planning to?
No, you're talking about the petrol pump, is it?
Correct.
No. Yes. We have one in-house petrol pump since our plant is on the main highway. We had used it earlier for logistics, and currently we are using it for any transporters who bring in raw materials or take our cement outside. But we are not planning to expand or whatever with that. Since that we are right on the main highway, we are just utilizing it to our advantage.
Okay, that is a nice thing to know. And we are, how much the volume growth has been in cement for Q4 to Q1?
So the volume growth from Q4 to Q1 is around 7%, but year on year is around 42%.
Okay. So subsequent quarters also, I think Q2, Q3, we should see the improvement, right?
Absolutely. As such, we are already seeing some improvement in July, and we will continue to do so. So we are being very aggressive in sales and marketing, which is why I mentioned to you, even though on average South prices, increased or prices decreased by around 3%. It only decreased by 1.2% for us. However, volumes year on year, South increased by only 9%, but we increased by around 42%. And it will continue to do so.
Okay, great. Thank you. That's it from my side.
Yeah, thanks a lot, Mr. Akhilesh.
Venkatesh sir, we have few questions in the chat box, so we'll take them. We have a question from Mr. Karthik Raja. Why our material cost is 55% of overall expenses, whereas competitor of similar size is around 12 to 15%? Please provide some insight.
So you're talking about cost of goods sold, is it?
Material cost, yes.
No, I mean, we will have to look at a very specific organization, other things, because what our cost of materials is going to be little high, not so much high like what it has been projected, little high because we are purchasing limestone, and by cost, there is only maybe 5 to 6% cost difference between when someone has a captive mine compared to when we purchase it from outside. Apart from that, our fuel consumption also is little higher. Right now, even though we have started a new kiln, it has not reached the efficient stage compared to others. But the difference should not be like almost 50% what has been projected. It would be good to look at any particular company and what they are showing to make a correct judgment. But as of now, with the kind of fuel and power consumption that we have done, we should not be more than 25 to 30% away from what others are doing.
Thank you. Next question is whether a ramp up is as per plan, or do we see any hitches to reach full capacity?
So as such, in fact, we had a significant roadblocks last year, and whatever remaining roadblocks that we had in the beginning of the quarter, to a large extent, have been resolved. And as of now, I can very safely say that the hookup of balance equipment is going on in this month. So we should be able to have a full capacity by the end of Q2 without any challenges, because most of the challenges, it looks like we've already overcome on it now.
Okay. What would be our renewable energy capacity by 2030?
So renewable capacity right now is around 40 megawatt peak, and unless we add another capacity, it will continue to remain same. And if we have to add a new capacity, we would be looking at it after the cement plant stabilizes. So we are looking to add another 30 megawatt once eventually we see some strong ramp up in cement and stabilization in this side.
Thank you, sir. Mr. Vinod, please go ahead with your questions.
Hello.
Yeah,
Good afternoon, Ajit. Go ahead.
Good afternoon, sir. Sir, my question is regarding solar. So with 60 to 65% solar output sold in the market, are there any long-term PPAs in place, or is it sold in the spot market?
So what happened was our solar plant was established when there was a lot of incentives from the state government. We, in fact, as a strategy, did not sign the PPA because PPA would have locked us on the pricing. Imagine if we had signed a PPA in 2018 when the solar plant was commissioned, the price we would have realized around 5 rupee 50 paisa or 5 rupees at that time. However, FY24 we realized average price of around 6.8 rupees, and now the average price is around 5.98. The only reason we are not signing PPA is because we knew at some point in time in future we would do this capex. So once we start reaching 60-70% of the capacity, we will not have enough power to be sold. So we are selling the power not in spot market but to the industrial customers. Out of we have around 14 to 15 customers who are authorized to buy from us, and whoever is giving the best price, we are selling it. In fact, all our customers are so huge that last 2-3 months we just sold all the remaining power to just one customer.
Okay, sir. Sir, and what is our current market share in operating regions? And how much can it be expanded with the improved capacity, extended capacity? So how much can we improve on that?
So I can give an understanding. In the areas that we are selling, like typically North Karnataka, South Maharashtra, and entire Goa, around 25 to 30 million tons cement is being sold, and our capacity is just 1 million ton. So our capacity, or in some of the strongest areas, we would have reached around 10% of the market share. On average, about 3 to 4% is what we are seeing. But yes, that also gives us a lot of scope of improvement now, which we have done successfully in Q1. So we did dig in deeper. We increased the sales within the existing market itself, and that we will continue to do so. And we already have one locational advantage, which means that some of the regions where we are selling, like Goa and South Maharashtra and North Karnataka, we are closest cement plant compared to most of the largest cement plants, barring the few. So yes, the market share maybe 3 to 4%, and if we keep digging deeper, we might reach 5 to 6%, and that should be almost reaching out to our million ton capacity.
Okay, sir. Then another question on solar. So solar contributes significantly to our profitability. And you mentioned, I think that
yes,
you have
EBITDA.
planned to, and you have mentioned that we are planning to expand the solar capacity, right?
Eventually, yes. I mean, the management is of the opinion that we should consider adding more solar capacity. But as such, right now, it is on the board table just for discussion and when we want to take up the project yet.
Okay, so that's all from my side. Thank you so much.
Thanks a lot, Mr. Viranji.
Thank you. So we have few questions. With 65% capacity utilization in FY27, can we expect to reach over 100 crore EBITDA in FY27?
With 65 to 70% production levels, 100 crore EBITDA is a very safe bet. Yes, we should be able to do that.
Next is, can you quantify the total repayment of debt for FY26 and FY27?
So FY26, we have around 25.8 crores as a repayment liability in FY26. So FY27, it will go down to around 20 to 21 crores. And FY28 onwards, it will be less than 15 crores for the existing debt. This year is the only year where we have highest liability for term loan repayment. Next year onwards, it is reducing because out of all the loans, 3 term loans will be closing this year itself, which will save us. Plus, with the new loan that we have secured for this capex, in spite of that, the net repayment of liability and obligation will start going down from Q1 of FY26.
Thank you, sir. Akhilesh sir, your hand is still raised. Do you have any more questions?
Achilles, you're on a mute, I think so.
I think there are no questions from his end. Okay. Mr. Kush, please go ahead.
Actually, sir, I just wanted one more information. So, what is our guidance for the FY26 and the EBITDA margins as well?
So assuming the prices remain stable like what we are seeing,
Mm-hmm.
so this year, if we see the same cycle of pricing that like what we have seen, typically Q1, Q2 prices go down, Q3 prices increase, Q4 prices are generally the best. Assuming the cycle continues and we reach for 45% of our capacity utilization, so I could safely assume that our EBITDA will be in the range of 50 to 60 or 55 approximately.
Okay. And margins would be around 25%.
25 to 30%, yes, we could safely assume.
And what was the absolute number for EBITDA? 50 to 55 crores, right?
Yeah, on average 55 plus or minus 5 you could consider.
Okay, sir. And can you please repeat one more time what was the realization per this ton for cement?
So EBITDA per ton for this quarter we realized around 365 rupees per metric ton, which is the highest since inception so far.
And what is for industry? It was around 500.
So for South-based industries, I have only, this is the study how I have achieved on how is India and South-based. So there are about 17 companies which I had looked at. Out of 17 companies, 3 of them predominantly operate only in South. So if you look at the average of EBITDA per metric ton for South, it looks to be around 560 rupees, whereas we reached around like 360 rupees. Again, because it's just the beginning for us, our fuel consumption and power consumption efficiency has not been achieved like what we had projected. And eventually what we're expecting is to hug the South-based parameters.
Okay. And we are confident that we'll be able to pace up with our peers, right?
Pace up with what?
With our peers, like around, we are going to see the upward trajectory only.
Absolutely, yes. Absolutely, yes.
Yeah.
Because capacity is increased by 3 times. So there is an aggressive push on sales. So simple 42% increase in sales from year on year itself is an indication that what kind of sales strategy we are putting in place.
Correct, sir. And just for my knowledge, can you also share what is the new capacity addition we have done and what is the total as of now after the new capacity?
So our capacity was only 0.360 million tons earlier. Now it is 1 million ton.
Okay. So before it was 0.360 million.
Yes.
Got it, sir. Thank you very much.
Thank you, Kush. We have few questions in the chat box. When can we expect to start RMC plant?
Yeah, like discussed earlier, the earlier plan was to start off in Q2 or the beginning of Q3, but we just want to make sure the cement plant is stabilized first because the RMC plant is an easy entry plant. Since company has already purchased the land for RMC, once we see a strong stabilization in cement, we will immediately go ahead and establish our first RMC plant. So if we are expecting some stabilization in Q2, by end of Q2, maybe by end of Q3, we should, plan to work on first RMC plant.
Question is, what are the synergy for venturing in RMC? Lot of peers have issues in connection in RMC, making single-digit margin.
Yes, RMC are known to have a very small margins, but this is where it will make a difference. First, most of the variable cost, the highest cost for an RMC is cement. And because of irregular cement prices, what we see, typically cement prices sometimes very weak over a week. In our case, we will have a strong, possibility of having our own cement and converting it into RMC. Some of the mixtures that RMC plants do in the RMC plant, we can do it in our plant itself and bring it to RMC unit to add water and little other materials. So there are some strategic advantages what our company or any cement plant company will have to to go with an RMC plant. See, one more good example I could give you is typically on a cement bank you can see the brand, which will give the brand equity and brand premium. But in RMC, what typically happens is most of the RMC products go to the either institutional buyers or it's most of a B2B kind of a transaction, which means that for the similar grade, we could get a better pricing compared to if we were selling cement in the bag itself. So those kind of synergy will help us to bring in a little better than better margins compared to other RMC plants who do not have their own cement plants.
Can we expand current cement capacity to 2 MN tons?
Can we expect current cement capacity to what?
Expand current cement capacity to 2 MN tons.
To increase the capacity of current cement capacity?
Yes, current cement capacity to 2 MN tons.
2 million tons, okay. So our current kiln is designed in such a manner that eventually we can increase the kiln output by which we could technically reach around 1.6 to 1.8 million tons. But that will happen once again couple of years down the line once we start reaching around 70% capacity. All that we have to add is more crushing capacity and grinding capacity because the existing kiln is sufficient to give us enough clinker to produce around 1.6 to 1.8 million tons of capacity. But that will be in the future, maybe once we stabilize around 70% of capacity utilization.
Thank you, sir. Next question is, any net debt EBITDA levels company is targeting? What's the vision for next 3 years?
So the debt will continue to go down as we move forward and as it can be seen. In fact, the debt has been serviced regularly. Couple of years down the line, since I mentioned to you that the 3 term loans are getting closed this year, out of which 2 have already closed as of Q1 and another to be closed by Q4. So debt will continue to go down unless we want to add a new cement or a RMC plant in future.
What's the vision for next 3 years?
Based on the current strategy for the existing debt, the debt will reduce to almost about 30 to 40% of debt will be repaid in the next 3 years. Or approximately you can say around 70 crores of debt will be repaid in the next 3 years.
Thank you, sir. Yes, Mr. Karthik Raja, please go ahead with your questions.
Hello, Mr. Venkatesh. I congratulate for the very solid numbers and a wonderful on-time execution of the expansion. I truly appreciate all the efforts. I have 3 questions. Our material cost expense is almost 50%, whereas of our similar size competitor material cost is around 12 to 15%. Why our material expenses are very high? This is my first question.
Okay, I mean, so to do a little apple-to-apple comparison, most of the cement plants do have WHRs and WHR and other sales. So currently, as I can say, when we look at EBITDA per ton, would be the correct way to look at it because, for example, even though we have not reached the optimum level of fuel and power utilization, but even now we are not more than 25 to 30% away from what they have achieved. Once we start achieving the results with the very low correct fuel and power consumption, our EBITDA would be almost equivalent to what other South-based industries will be doing. So when we say the cost of materials, it could be little, I mean, these figures have to be checked on where they are arriving from, but EBITDA per ton would be the most correct statistics to go with.
Okay, so do we have a limestone mine like on lease, or we are buying from ad hoc price, um, something like this. So that is because most of the other competitors are having the secured limestone their own mine, so they mine and they use it as a raw material. So how about us? Are we buying limestone from outside third party or some related party from our promoters company, something like that?
So the company has around 300 acres of mining lease given by the government of Karnataka. However, there is a dispute on the ownership of the land, which the matter has gone to the Supreme Court. Till that is resolved, we are purchasing limestone from locally. And one very good thing to tell you is we are the only buyers of limestone in that area. So all the limestone mine owners, there are a couple of other plants who have their own captive mining. Since we are the only buyers, we tend to have a better pricing. And of course, the compared to captive, the pricing is a little higher. But then the limestone itself does not contribute significant cost. Typically, limestone, by quantity, it consumes almost 95% of the volume, but by cost, it is about 15 to 16%. So compared to other cement plants, they have almost 20 to 30% price advantage compared to us. So which means that if 15% is what we are dealing with, they will their cost will come down to around 10 to 11%.
Okay, my second question is so we need to ramp up to 100% to see how our new plant able to do it. So I understood that next 4 quarters we would be taking for a slow ramp up. Are we seeing any technical glitches to ramp up, or we so far we are good and we have a full support from our suppliers? Do you give some insight on our ramp up plan?
So no, we definitely have an excellent support from our suppliers. But again, cement plant, hardcore machinery, hardcore metals everywhere. For example, kiln, even though we expected, kiln did not give any mechanical problems. But then, since the balance equipment was not ready yet, the fuel consumption was a little higher. So since the balance equipment is getting ready by the end of, by this month or maximum by next month, so then we would be able to see kiln performing at the levels what the suppliers have promised us and given the guarantees at this point in time. So as such, we don't see any hiccup right now. Whatever issues we had, 99% of it, we are already through it. In fact, our project got delayed for a certain period of time due to a lot of other issues, but we have overcome all of them right now, and we are at the cusp of, completely closing and putting the plant in operations on 100%. Main part of the plant, like kiln, has already been ready and commissioned. The little smaller things here and there will be hooked up as we move along.
Okay. My last question. So I understand our management have a good gesture against the future generation. So we are running on renewable energy. I totally appreciate on this for our future, considering future generation wellness. So what would be our estimated capacity by financial year 2030? So 5 years from now, can we see solar capacity as a main business of ours? Any vision or any brainstorming happened on this with management? Can you give some insight? I don't hold based on the numbers what you give now, but I just want to see management vision on the renewable capacity.
Absolutely. So this is what the management overall thinks. It is like it is still in the close boardroom discussion. But yes, I think our shareholders should be privy to such information which will help them. So typically, what the management thinks is management is capable in two things very good. One is cement, another is establishing solar renewable power, and we have necessary experience. So what we believe in is, even though we are building new solar capacities for captive consumptions, but solar industry itself, the renewable power itself, has a very high, it has got a good future, mainly because of a couple of things. One, eventually solar would be the only way you could produce the cheaper hydrogen. And it appears that hydrogen could be one of the fuel in futuristic India if we have to go for non-fossil based or oil based fuel for our vehicles and other things. So that is one direction what management feels is a good direction. And RMC, because setting up multiple RMCs across North Karnataka, South Maharashtra, or multiple RMCs would mean that we would stop eventually selling cement, but selling only RMCs. What it gives is, it typically eliminates most of the middlemen, and we reach out to the customer directly, where net realization available for the plant will be higher. And with the RMCs, what happens is your technically top line will go extremely high. Even if there's a small EBITDA generated from as a percentage from RMC, but because of very high turnover, those absolute EBITDAs also are going to be very significant. So overall, that's the direction what management thinks should go. But again, this is like you really rightly mentioned, it is still in the closed doors. We are still not very sure that this is the right strategy or this is the final strategy to go with. But that's the direction what management is thinking right now for next 5 years.
Thank you, Mr. Venkatesh. Thank you, Kirin Advisor, for giving me opportunity. I wish you all the success. Thank you.
Thanks a lot,
Thank
Karthik.
you. Next question, please. Investors, if you have any further questions, kindly raise your hand, or you can also drop your questions in the chat box. Venkatesh sir, I think we have covered all the questions. If there are no further questions, can we conclude the meeting?
Yes, I would like to just take a formally, I would like to thank you all the investors and all those who have asked the questions and have participated. It was a great opportunity, and thank you for everything.
Thank you. Thank you everyone for your time and participation. If there are any further questions, kindly reach out to us at research@kirinadvisors.com. Thank you, Venkatesh sir. Thank you, Vikas sir. Thank you, Arshil. Thank you, everyone. Have a great day ahead.